The investor who put money into the market every single month without ever checking the news, without ever trying to time anything, and without any particular skill or insight, beat the vast majority of professional fund managers over the last 20 years. That is not a motivational claim. It is a documented result that has been measured, back-tested, and replicated across multiple market cycles and multiple countries. The strategy behind it has a name that sounds almost embarrassingly simple, given how powerful the outcome is. It is called dollar-cost averaging, and the reason most people underestimate it is the same reason most people underperform the market. They confuse complexity with effectiveness. The financial industry has a structural incentive to make investing feel complicated. Complicated investing requires advisors, analysts, premium research subscriptions, and active management fees. Simple investing requires almost none of those things, which is exactly why the simple version rarely gets the marketing budget or the primetime segment. But the evidence for simplicity is overwhelming, and once you understand exactly how dollar-cost averaging works and why it works, the temptation to overcomplicate your approach starts to lose its grip. Dollar-cost averaging means investing a fixed dollar amount at regular intervals regardless of what the market is doing. Every week or every month, the same amount goes in. When prices are high, your fixed amount buys fewer shares. When prices are low, your fixed amount buys more shares. You never have to decide whether the market is at a good entry point, because you are always entering. You never have to wait for the right moment, because every moment is your moment by design. The mechanics are straightforward, but the psychological effect is profound. Most investors who try to time their entries spend enormous mental energy monitoring market conditions, second-guessing their decisions, and waiting for clarity that never fully arrives. The market drops and they think it might drop further, so they wait. The market rises and they think they missed the entry, so they wait. The waiting becomes its own trap. Meanwhile, the consistent investor is simply executing the same action every month and accumulating shares at whatever price the market offers. Here is what that looks like in real numbers. Imagine you invest $500 every month into an S&P 500 index fund. In January, the fund is priced at $100 per share. Your $500 buys 5 shares. In February, the market drops and the fund falls to $80 per share. Your $500 buys 6.25 shares. In March, the market recovers to $90. Your $500 buys 5.56 shares. You now own 16.81 shares, with an average cost of $89.23 per share, even though the price has bounced between $80 and $100. You automatically bought more when prices were lower without having to make a single prediction or decision. This automatic accumulation of more shares during downturns is the mechanical advantage that makes dollar-cost averaging genuinely powerful over time. You are not just avoiding the emotional mistakes of market timing. You are structurally set up to benefit from volatility rather than be harmed by it. Every market dip that terrifies the investor trying to pick the perfect entry point is a sale event for the dollar-cost averaging investor. The back-tested evidence for this is compelling across multiple time horizons. A study examining rolling 20-year periods in the U.S. stock market found that consistent monthly investors who never tried to time the market achieved returns within a remarkably close range of the theoretical perfect investor who somehow bought only at market lows. The difference between perfect timing and consistent investing was surprisingly small. The difference between consistent investing and the average investor who tried to time the market was enormous. The enemy of good returns is not market volatility. It is the behavioral response to market volatility. Consider someone who started investing $500 per month in January 2000, right at the peak of the dot-com bubble, perhaps the worst possible moment to begin investing in a generation. The market immediately dropped over 50%. Then, September 2001 brought further devastation. The recovery was slow, and then the 2008 financial crisis cut the market roughly in half again. By any measure, this investor picked an extraordinarily painful starting point. But because they kept investing through every drop, they were buying shares of the market at dramatically reduced prices during the crashes of 2002 and 2008. By 2020, that investor had accumulated a portfolio worth well over $300,000 from 240 monthly contributions of $500, totaling $120,000 invested. The market did the rest. That example is important because it addresses the objection most people raise when they first hear about dollar-cost averaging. They worry about starting at the wrong time. They worry about investing into a declining market. The back-tested reality is that starting at the worst possible time and staying consistent still produces substantially better outcomes than waiting on the sidelines for the right moment that never clearly announces itself. Setting up dollar-cost averaging in practice takes about 10 minutes and then runs on autopilot indefinitely. Most brokerages allow you to schedule automatic recurring investments into any fund or ETF on a weekly, bi-weekly, or monthly basis. You choose the amount, choose the investment, set the schedule, and then the system executes without requiring any further decision or action from you. This automation is not just convenient. It removes the single biggest obstacle to consistent investing, which is the moment of decision. Every time you have to actively choose to invest, you create an opportunity to talk yourself out of it. Automating the decision removes that friction entirely. The amount does not have to be significant to start producing meaningful results. $50 a month invested consistently from age 25 grows to something genuinely substantial by retirement. $100 a month becomes more substantial. The specific amount matters far less than the consistency and the timeline. Starting with whatever you can genuinely afford to automate and forget about is worth infinitely more than waiting until you can afford to invest a larger amount. There is one nuance worth understanding about dollar-cost averaging versus lump sum investing, because the research here is slightly counterintuitive. Studies consistently show that investing a large sum all at once outperforms spreading that same sum over time, roughly 2/3 of the time. The reason is simple. Markets go up more often than they go down, so every day your money sits uninvested, waiting for the next scheduled contribution, is a day it is statistically likely to be missing out on gains. If you receive a windfall, an inheritance, a bonus, a tax refund, the mathematically optimal move is usually to invest it immediately rather than spread it out over 12 months. But here is why that finding does not undermine the case for dollar-cost averaging. The lump sum advantage only applies when you actually have a lump sum to invest. For the vast majority of people investing from regular income, there is no lump sum. There is a paycheck, recurring expenses, and whatever remains. Dollar-cost averaging is not a compromise on the lump sum strategy. It is the correct strategy for someone investing from income rather than from accumulated wealth. You invest when the money arrives because that is when the money exists. The real secret of dollar-cost averaging is not mechanical. It is psychological. It gives you a framework that makes the right behavior automatic and removes the conditions under which bad behavior typically occurs. You cannot panic sell at a market bottom as easily when your next scheduled contribution is going in the following week. You cannot get caught up in market timing paralysis when the decision has already been made and automated. You cannot be shaken out by volatility when your entire system is designed to treat volatility as the mechanism through which you accumulate more shares at lower prices. The market will go up and it will go down, and nobody will tell you reliably in advance which is coming next. What you can control completely is whether money goes in on schedule, regardless of the answer. That control, exercised consistently over a long enough time horizon, is what separates the investors who actually build wealth from the ones who spend years waiting for the right moment that never comes.